Good evening, everyone. On, be- on behalf of Women and Young Members Excellence Committee at ICAI, I extend a warm welcome to all of you to Youth Excellence Synopsis Series. This series is conducted by the committee to share technical updates, enhance non-technical skills, and encourage our members to confidentially express themselves in public forums. This initiative aims to upskill and inspire our members to step forward and make the most of their abilities. The series is conceptualized by the chairperson of Women and Young Members Excellence Committee, CA Preeti Savlati, who is also chairperson of Sustainability Reporting Standards Board and vice chairperson of Valuation Standard Board for year 23-24, and our vice chairman of Women and Young Members Excellence Committee, CA Abhay Shajarji, who is also chairman of Commercial Laws, Economic Advisory, and NPO Cooperative, and a Vice Chairman of Accounting Standard Board for 23-24. Youth Excellence Synopsis aims not only to provide essential updates on technical knowledge but also to foster non-technical skills. We aim to empower and inspire our members to confidently step onto the public stage and excel in their verbal expression. Our today's session of Youth Excellence Synopsis number 23 was supposed to be held by Mr. Abhitan Mehta, but due to not due to weakness in health, we have a different speaker, Mr. Suril Mehta, for Mergers and Acquisition, Vadodara. Suril, sir, with over a decade of experience, is a part of transaction advisory practice of KC Mehta Company LLP and leads the team in tax and regular advisory, restructuring, strategy formulation, and valuation services. He has a vast experience in closing M&A transactions, including negotiations, structuring for a legal, regulatory, and tax perspective, and other transaction support services spanning across a wide range of industries, including pharmaceuticals, chemicals, auto components, technology, and research and startups. He has advised clients seeking inbound and outbound investments, opportunities, family-owned companies planning an exit, domestic, global domestic or global joint ventures, and shareholder entry and exit strategies. Suril is also involved in certain niche sectors like shipping industry, education sector, BFSI sector, etc. Suril has researched extensively and advised on tax implications across jurisdictions and developed strategies for tax and regulatory optimizations over the years. He has been worked on projects involving complex restructuring in US, China, UAE, Switzerland, Singapore, Netherlands, Tanzania, Congo, and has dealt with consultants for several other jurisdictions. Suril is actively involved in advising Indian and overseas clients to set up operations in the GIFT City IFSC, including fintech, alternative investment funds, family investment fund, entities, etc. His team has made representations in past to the GIFT City IFSCA, which has led to favorable changes in regulation. So, I extend warm welcome to our speaker, Mr. Cyril Mehta, and to lead it forward. Thank you.
Thanks for the introduction. Thanks, Preeti, thanks, Deepji, everyone who has given me this opportunity to speak. I would just request this because it's a small audience. I would just request this to be as interactive as possible. Anyone can just post messages and I'll be more than happy to respond. If it is possible to unmute the mic, even that's absolutely fine. So I'll just start with the topic. I would want to speak something on transaction structuring. According to me, so this field is something which is very lucrative and an upcoming field. Without much ado, I'll just start with some of the cases which will help relate better to what transaction structuring is about. Just a minute. Yeah, so one of the possible use of transaction structuring is repatriation. In case of an Indian company which is repatriating dividend for an Indian resident, the tax cost is somewhere around 36%, which is a lot. 30% plus surcharge of 15% and 30% plus surcharge of 15%, education cess of 4%. So and in case the dividend is received from outside India, it is still going to be taxed at 25% for the company unless the company distributes it further. So these are the very restrictive provisions because of which a company would ideally want to try to find out alternate ways to declare dividend. I'll give you a few examples. I am just openly going to discuss the strategies. These are all implementable strategies. We have actually used this. And this is something that even you as an audience can use this. One of the strategy is like to start with something simple. Let's say there's an Indian company wants to repatriate money outside. One of the simple possibility can be using, which is commonly used, a salary or a bonus mechanism, right? So what happens is that bonus or salary is taxed at a maximum marginal rate of 39%, gets a deduction in the company for 25%. Effectively, that results into a tax cost of 14%. So this is a decent strategy. As long as it's a simple structure, a family-owned company where you can give remuneration only to one person in case there are multiple shareholders, and the bonus is given in the form of the profit sharing ratio of the shareholders. In that case, this becomes difficult because there's a condition in 36(1) which mentions that the bonus or remuneration should not be in lieu of dividend. If it is the case, then that bonus will be disallowed, and then the dividend will be taxed at an even higher rate of 39% instead of 36%. But this is a commonly used strategy, nothing wrong with that. In case there are any non-resident, this may become even more lucrative. Let's say in case there's a non-resident company, a foreign company which is involved, providing service to an Indian company, which is basically a structure which is used for repatriating dividend, then the tax cost can be even lower. I'm not here only to give the strategies, but the risk involved in implementing these strategies, and which is, according to me, what is the important thing with respect to transaction structuring. So when a foreign company actually gives services to an Indian company, and the Indian company pays money to the foreign company, there are a few risks that may get involved. One is transfer pricing. If the two companies are rated, then arm's length price has to be determined for this transaction, and only if ALP principle is satisfied, only then the deduction is allowed to the Indian company. There are other risks, like there can be a permanent establishment risk. So in case it is determined that the activity of the Indian company is being carried out in UAE, then the UAE government may charge the profits of the Indian company to the permanent establishment which is created in UAE. Right? Recently, there's a new tax law which has been brought out by the UAE government, which has become effective, and they have the concept of PE also in the tax code. So these are some of the simple strategies which are possible in case of dividend. One of the other simple strategy which is still surprisingly less used is, let's say, if the Indian company has overseas subsidiary. Again, let's take an example of a UAE subsidiary. It can be a UAE subsidiary, it can be a Dutch subsidiary, it can be a US company, right? Any of these company. That company wants to declare dividend to the Indian company. Again, the tax cost is high. The tax cost is 25%, and I'm assuming that the money is not something that the Indian company has to further declare to the shareholders. So in that case, one of the strategy can be inbound merger, where the foreign company, which is a subsidiary, simply gets merged with the Indian company. Merger is tax free. So there is no dividend tax cost, there is no capital gains, etc. So in this tax free manner, the money can be brought to India. Alternatively, if amalgamation is not suitable because you want the subsidiary to remain active and you don't want that subsidiary to close down. So subsidiary has something like $20 million. It wants to repatriate this $20 million to India. It still wants to remain active. So in that case, there can be a demerger. An inbound demerger can be carried out where that division assuming it's an investment division, that division gets demerged to the Indian company. Again, this transaction can happen tax-free. Simple transaction, but when we get into this, there can be a lot of complications. I'll discuss some complications. Mainly, the idea is to appreciate that uh, while a strategy can be an extremely effective tool, the success in transaction structuring will be if a strategy is properly executed. So some of the possible issues that can happen in this situation, in case of an inbound merger, uh, there are a lot of countries which, for those countries, let's say for a US or a UAE or a Netherlands company, this is a outbound merger because that company is getting merged with an Indian company. So for them, it's an outbound merger. A lot of countries actually do not permit outbound merger. Right? India surprisingly does, because in the New Companies Act, there are restrictions, but it still permits outbound merger. US also does permit outbound merger, but very few countries like UAE doesn't permit outbound merger. Netherlands permits it only if it is restricted to EU region, not outside EU. So a lot of very effective intermediate holding companies jurisdiction do not actually permit outbound merger. So what happens in this case? One of the alternative is to do a redomiciliation. So let's say there's a Netherlands subsidiary. Luxembourg provides Luxembourg, Liechtenstein. These are the countries that provide outbound merger. So one of the possible option is to redomicile. What redomiciliation means is that that's a term which is not very commonly used because in India redomiciliation is not possible. But in a few countries, it is possible that a company changes its registration. So a US company can become a Netherlands company, or a Netherlands company can become an Irish company. Right? We are not talking about the tax residency. We are talking about from the jurisdiction from a company's law perspective. Right? So earlier, Netherlands law may be applicable, Netherlands corporate law may be applicable, but now it gets deregistered in Netherlands, gets registered in, let's say, Liechtenstein, and then go for an outbound merger. So this is one of the strategy which is possible. It's a long drawn process, and again, here you will imagine that again the requirement is that that country should allow an outbound redomiciliation, right? So there are countries that allow inbound redomiciliation; they would not allow outbound redomiciliation, like Singapore, right? Singapore, even UAE doesn't allow anything. UAE also would not allow outbound merger or outbound redomiciliation. In that case, one other strategy which is possible is to close down that company and carry out a merger process in India. Right? That is also one of the strategy which is possible to explore. What are the flip sides of implementing this strategy? Again, the purpose is to get tax-free money back to India in all these strategies. So now, what are the flip sides of doing a winding up? Let's say again, subsidiary is a UAE company, 100% subsidiary. A UAE company is wound up because UAE doesn't have a merger law itself, and in India, a merger process is done. NCLT merger process is done. I'll just share the screen for discussing 2.1b, section 2.1b, which talks about amalgamation. Interestingly, when 2.1b talks about amalgamation, the interesting thing here is that it talks about merger of one or more companies. Again, merger is not defined. Amalgamation talks about merger is not defined. There is no need for this transaction to be done through NCLT. So one of the question is that for being regarded as amalgamation under 2.1b, do you need to do a scheme under NCLT, or can you do a scheme even outside NCLT and still it will be falling under amalgamation? It's a food for thought. Love to hear your responses. So that is one thing, that there is an absence of any mention of section 30, 230, 232, etc., which is mentioned in demerger. It's not mentioned in amalgamation. So amalgamation talks about merger of one or more companies. The common questions can be that can buyback be considered as amalgamation, can capital reduction be considered as amalgamation, etc. The interesting thing which is relevant for our discussion is the last paragraph. which says that amalgamation means so and so. So merger of one or more companies with another company, uh, provided XYZ conditions are satisfied. So these are the conditions, right? We are not on the condition. There's one more condition which is given at the end, which says that otherwise there as an acquisition of property of one company by another company, right? So acquisition of property is clearly out if it is pursuant to purchase of the property. So the Indian company cannot purchase the property of UA company. Otherwise, it's a merger, but it cannot purchase the property of the UA company. Or and there's one more exception, that it should not be as a result of distribution of such property to the other company after the winding up of the first mentioned company. So there cannot be a winding up of the UA company after which the property is getting transferred. The interesting point here is winding up and the term after, right? So if the property gets transferred after the winding up process, in that case also it is not an amalgamation. In this case, as per the UAE law, the winding up, when the winding up happens, the property has to get transferred before the winding up process. The balance sheet has to be completely zero. After the balance sheet is zero, only after that liquidation happens. Right? So that's an interesting point to note. That because so again it begs the question as to whether this structure is possible or not. Winding up the UA company, liquidating the UA company, and the property gets transferred to India. In India, there's a merger process carried out. Right. Again, the question is whether the merger process is required altogether or not. But I'll leave it to the audience in case you have any questions for that. But these are some of the possibilities that the UA company can actually be wound up. The property is not getting transferred after the wounding up process, but before the process. And because of that, it may still fall under amalgamation definition. The other interesting point is sometimes we actually take some commonly known terms very casually. And so what is actually meaning of winding up? There's another interesting point of dividend under 222 defines dividend, and 222C defines that any dividend includes any distribution made to a shareholder of a company on its liquidation. Right? So these are two different terms which are being used. 21B uses the term winding up. 222C uses the term liquidation. What is the difference and what is the impact in this situation? I'll share some of my thoughts, not a conclusive thoughts. Again, in case you have any questions, please let me know. My idea is not to give you clarity. My idea is to give you what all confusions can arise, and because each and everything requires a huge amount of research to understand that how can this strategy be used. Right? So the strategy that we are talking about is that there is an Indian company which has a subsidiary in UAE. That subsidiary is getting wound up. Right? So in that case, is there a risk of 21B? We saw that it is possible to contend that 21B doesn't apply. Second, is there a risk under 222C? Can it be considered as dividend? Right? The question here is what is winding up, what is liquidation, what is the difference between the two? Winding up is actually a process of a company shutting down its operation or a company going for a liquidation. Liquidation is a point of time, it's an event. Right? So I am carrying out the winding up process, it may take 12 months. After 12 months, on let's say 1st May 2023, the company has got liquidated. Right? So liquidation is happening on 1st May 2023. So that is the date on which the liquidation happens. Interestingly, the terminology used here is any distribution made to shareholders on its liquidation. Not before its liquidation, not after its liquidation, it says on its liquidation. So that essentially means that only the distribution which is made on its liquidation is supposed to be considered as dividend. Again, as we discussed, in case the distribution is made before the liquidation happens, it may not be considered as dividend. So this is the strategy of, in case of an outbound transaction where there is, let's say, an Indian MNC having overseas subsidiary, these are the strategies that can be used. Right. So the strategy that we discussed is that one is inbound merger, one is redomiciliation and then merger, one is winding up and then carrying out a merger process, may or may not require to carry out a merger process in India. Any questions till now? Okay. So there's another, in case of transaction structuring, the other common aspect which is relevant is capital gains. Right? So in case of sale of shares, there's capital gains involved, which is fine because sometimes it may not be a very big pain. But the pain point is that in case there is swap of shares, there's no money that the seller receives. So what happens in case of a swap of shares? I sell my shares, and against the shares that I sell, I get the shares of the buyer company. Right? Let's say I have a small company, I sell that company to Reliance, and I get shares of Reliance. I'm okay with that. Right? Getting shares of Reliance for me at least is as good as cash. So I may be okay with that. But unfortunately, a lot of countries actually recognize that even a swap of shares is considered as similar to merger. It's a non-cash transaction, therefore it would not be taxed. In India, swap of shares is taxable, which is a problem because I'm not getting any money, but I still will end up paying tax on that. So, what all are the possible strategies to overcome that tax implication? One of the possible strategy can be simply a demerger. So, in case my company, instead of selling the shares of my company, that company can demerge or it can even merge. Right? There can be a merger or there can be a demerger. So my company, let's say company X, gets merged with Reliance, and against that, as a consideration for merger, I get shares of Reliance. That's a simple transaction, which is a tax-free transaction. The difference, the interesting difference between merger and demerger, not the thing. I mean, we would generally know that in case of demerger, a division is transferred. In case of merger, the entire company gets transferred. Right? This is the generally acceptable difference between merger and demerger. But some other interesting differences. In case of demerger, there has to be an undertaking. So undertaking is defined as, I'm just putting it simple to take it forward. So undertaking is defined as any group of assets and liabilities which form a business activity. Together, it has to form a business activity. So that is what is the meaning of undertaking. So there has to be an existence of an undertaking for it to be considered as a demerger. Also, the transaction has to happen in going concern basis. There are other normal conditions also that in case of demerger, the shareholders of the demerged company should also become shareholders of a resulting company. Right? 75% in value of the shareholders of the demerged company should become shareholders of the resulting company. Interestingly, it says have to become shareholders of the resulting company. So here, even equity shareholders can become preference shareholders of Reliance in this case. There are no restrictions for that. I may be a preference shareholder of my company. I can get equity shares of Reliance. I can get preference shares of Reliance. I may be equity shareholder of my company. I can get preference shares of Reliance. Interestingly, what happens is that in case of preference shares, I have a right to receive that amount at a future date. So this is more like a loan. So this is an exit planning which can be done, that instead of selling shares and getting shares of Reliance and then selling the shares of Reliance in market, this can be a very simple transaction in which the tax can be at least deferred. In future, if I get equity shares, I can sell the equity shares. The interesting part here is that I'm reducing my tax liability from the normal 20, 25, 26%, which is 20% plus surcharge cess in case of an unlisted company, because now it's a listed company, the tax rate is only 10% plus surcharge cess. So 12, 13%, it gets done at around 12, 11.96%, right? Assuming the surcharge is maximum. So this is one advantage. There can be other advantages in case it's a preferences. Then instead of selling the preferences, it's also possible to redeem the preferences. And sometimes the redemption of preferences, the tax implication in case of redemption of preferences may be much more lucrative than sale of the equity shares. There are also possibilities that because now I have the flexibility of deferring my consideration, that shareholder can also become a non-resident in future in a country which is lucrative from a tax perspective, from a tax treaty perspective, like let's say Netherlands. And in this situation, it may be possible that the entire capital gains becomes exempt because of the treaty implications. Right. So this was regarding a sale of shares or a swap of shares. How can the taxation in case of swap of shares can be effective? One other commonly used structure is flipping the structure. So this was popularized by Flipkart. So Flipkart is, as you all know, it's an Indian company. It's an Indian e-com company, but Flipkart actually had a holding company in Singapore. Right. So Flipkart, to the investors, Flipkart was a Singapore company. They did not have to come to the Indian company. They could simply buy the shares of the Singapore company. Right. So these are known as flipping the structures, externalization. A few big corporates have done this. Vedanta has done this. There's a lot of there are possible advantages of doing this. The common notion is that investors will be more interested to come and invest in a foreign company than invest in an Indian company, right? So this can be a structure which is flipped with US as a holding company, Singapore as a holding company. Singapore and US are very commonly used holding company jurisdiction. So there can be huge advantages in case of flipping. Another advantage is that this foreign holding company can actually be listed in that country. Let's say a US holdco can be listed in US New York Stock Exchange. Singapore company can be listed overseas, either in Singapore or some other jurisdiction. Right. So all these advantages, all these options open up in case of flipping the structure. While this advantage also still continues to remain, where the Indian company can be listed in the Indian market, or the investors can directly enter into the Indian company if required. Right? So this is flipping the structure. In case of flipping the structure, the tax implications are not very favorable currently. Apart from tax implication, the FEMA implications are even more difficult to navigate. So I'll just share some thoughts on the tax implication. In case of flipping the structure, I as an investor or I as a promoter is selling the shares of the Indian company to get the shares of a foreign company, against which the foreign company will issue its own shares to the shareholders. Right. So I'll just depict that quickly. So what happens is that there's a Indian company. It's not getting recognized. I don't know why. Anyway, so I'll just explain that. I'll just try my best to explain that structure. So there's an Indian company with investors, maybe resident and non-resident investors. A new company is set up, let's say a US company, and the shareholders with very nominal investments get shares in the US company. The shareholder sells the shares of the Indian company to the US company, against which the US company gives the shares to the shareholders. Right? So the structure is flipped, where the investors now hold shares of the US company and the US company holds 100% shares of the Indian company. So this is a flipped structure. Uh, Difficulties arise with respect to tax and the regulatory issues. One is that swap of shares in this manner is not permitted under FEMA regulation, under the NDI regulations of FEMA, the non-debt instrument regulations. The second issue is with respect to tax. Assuming that this is, let's say, a startup with high valuation, in that case, this swap has to be carried out at a fair market value. So the tax implication can be very dire. Right? One of the possible strategies here is to do a disjoint demerger. In case of a disjoint demerger, the Indian company sets up another Indian company and demerges its entire business along with assets and liability to the new Indian company. And the new Indian company instead, no, in a normal demerger, the new Indian company would have issued shares to the shareholders. But here, the holding company of the resulting company, holding company of the new Indian company, will issue shares. So here the US company will issue shares. So this is one of the possible option to consider a flip, which is also going to be exempt from tax. These are some of the strategies that I thought that may be useful to the audience. In case, I think I'll open up for any questions. In case you have any questions, I would be happy to take them. Okay, I'll just go on with a few other strategies. One of the requirement need to sell the business, right, which is a slump sale. So when a slump sale happens, generally it is very lucrative for the buyer, not just for tax purpose, but even for legal reasons. It may be very relevant for the buyer. Here, the tax cost may be very detrimental for the seller. The reason of this is that there are two layers of taxation. Let's say a business is having a book value of 10 million, getting sold for $100 million. So that in case of slump sale, the company sells the business, gets a gain of 90 million, on which there is capital gains tax, 25%, let's say 20, 23, 24% capital gains tax the company will have to bear. After that, the shareholders wants the money. So there's distribution that happens to the shareholders, right? Which is again subject to tax of 36%. So overall, the tax cost is as high as something like 50-52% of tax cost with respect to money, bringing money to the shareholders level. This is much more than a normal sale, which would have had a tax cost of only 23-24%. Here also, it can be possible to carry out a demerger or merger, but generally, demergers or mergers are not very comfortable to structure in case a third-party transaction is to be done. Because at that point of time, speed is very essential. It is very crucial to do the transaction at a very time-sensitive manner. Okay? So in this case, one of the possible strategies that a wholly owned company, wholly owned subsidiary can be set up. The business can be transferred to the wholly owned subsidiary at a fair market value. This transaction is exempt from tax because under 47(4), any transfer to wholly owned subsidiary is exempt from tax. Then the wholly owned subsidiary has a higher cost base. So now the wholly owned subsidiary can then do a slump sale. In this situation, there is zero tax cost in case of a wholly owned subsidiary. So the entire tax on slump sale is exempt. The wholly owned subsidiary can then pass on the dividend to the Indian company, which can then pass on the dividend to the shareholders. So the only tax in this case will be the tax on dividend, which is 36%. One of the other strategies that can be linked with this strategy is that instead of declaring dividend, there can be a buyback which can be carried out. Buybacks are generally much more tax effective compared to dividend, with a tax rate on a gross down basis, it's only 18%. It's 18.89% to be precise on buyback. So this way the transaction can be much more efficient. Another strategy can be that in case of sale of shares, one of the requirement is that if the company is extremely cash lucrative, it has huge amount of cash surplus, but the company has not declared dividend to avoid the dividend tax, and it keeps on investing in mutual funds, fixed deposit, etc. In case there is a buyer that gets involved, buyer wants to buy the company, the buyer would generally want to buy the company without this cash. They would request the seller to distribute this cash or take it out of the company in whichever way the seller decides, and then they would only want the operating assets. And again, this becomes very detrimental for the seller because the dividend cost is huge. So here again, that division, which is a cash generating division, can be structured as if it's a investment division, and if the definition of undertaking gets satisfied, then this division can be demerged to another company and then the shares can be sold off. When a transaction happens so this is, we talked about dividend, we talked about capital gains. There are also some strategies to reduce corporate tax. One of the strategy to reduce corporate tax is that in case any transaction like a tax neutral transaction or even a taxable transaction happens, like a demerger, merger, sale to wholly owned subsidiary, or even a normal slump sale which is taxable, right? The cost base doesn't automatically increase. But what happens is that in case, let's say a slump sale takes place for $100 million, the book value is $10 million. So this is all generally considered as a succession of business. And in case of succession of business, there is no markup to the WDV, the tax WDV of the assets. So one of the possible option in this case for the buyer is that the difference $100 million minus $10 million. Generally, this difference is considered as goodwill, and goodwill is not depreciable, right? But the goodwill can be broken down into multiple intangibles, and these intangibles, individual intangibles, are depreciable. So what happens is that because of these intangibles, which are depreciable, the tax cost of the buyer reduces significantly. So this is one of the possible strategies to reduce the corporate tax rate. I think that's it from my side. So in case anyone has any questions, I'll be happy to answer them.
Hi, Suresh.
Hi, Priti.
Yeah, one of the question is regarding family investment fund provisions.
Yeah.
Okay,
Hi.
so yeah, it is recently launched, which provides tax incentive in gift city. Say, for example, private company has net worth of 50 crores in Mumbai. Can we create its holding company in gift city? Is this tax efficient or there are risks involved? In nutshell, can cash-rich private companies shift their base to gift city by creating holding companies?
Okay, excellent
One of the
question.
viewer
So
has
now I'm happy this question was raised. So this is a family investment fund which is eligible entity in Gift City. The family investment fund, I understand that the question is that this 50 crores with the Indian government. So just tell you a few provisions with respect to a family investment fund in a gift city. The technical term should not be gift city. The technical term should be IFSC. So I am assuming this is in IFSC. So what happens is that in case of a family investment fund, any income of the family investment fund is exempt from tax, from income tax for a period of 10 years. Out of any 15 years, there can be a 10 years period which can be considered for exemption. Apart from that, even GST is exempt for a family investment fund. The activities that a family investment fund can carry out is only investment activity. So a manufacturing setup or a full-fledged operating setup cannot be transferred as a gift city. But the holding of that entity can certainly be transferred to a gift city, and that is extremely beneficial. So what commonly a gift city FIF, family investment fund, can be used is where let's say in case of an Indian entity or an Indian individual having surplus money which they want to invest overseas, or real estate that they want to invest overseas. So this can be routed through a family investment fund, and any capital gains, dividend, rental income, etc. of this family investment fund is exempt from tax. So this is certainly a very advantageous situation, and because of this, family investment fund should certainly be explored. The requirement of family investment fund is to have a corpus of $10 million over a period of 3 years. So that is a condition which has to be satisfied. Apart from that, a family investment fund is considered as a person resident outside India from a FEMA perspective. So any investment from India to family investment fund will have to satisfy the overseas investment regulations of FEMA. Nothing very difficult about it. But as long as these things are satisfied, family investment fund is certainly a very strong tool because the entire income is exempt.
okay.
Any other questions? Yeah. So in case somebody wants to even unmute, if that's possible, happy to converse also. I would just like to say that this is a very interesting field, transaction structuring, and I feel that the demand is very high, the supply is not there. So very few people are actually focusing on this field. It's something that I would request everyone to do it, especially in case you have some. So I'll just give you a very interesting observation that I found. We were trying to heavily recruit people, and one of the very important requirement in case of transaction structuring is not actually tax, because a lot of people actually have some idea about tax, but FEMA is something which is unfortunately something that very few people know. So I actually had gone to LinkedIn and tried to see uh, in the whole of the country where are there people who actually have expertise on FEMA. So the thing that I found out is that generally it is only people from Big Four, or there may be some small firms who would have expertise in FEMA, where there are people who have expertise in. I'll just request that in case anybody is interested in this field, uh, I would humble request that this is something that should be considered. It's FEMA is not as difficult subject as income tax. It's much easier, much smaller, right? If you only read the OI regulations, the overseas investment regulations, and the NDA regulations, the non-debt instrument regulations, possibly 70-80% of FEMA is done just by these two regulations, and they are not even very big, maybe 30-40 pages. So that's something that should be considered. And in case anybody is interested in this subject, if it's possible, you can just contact me, and we have regular sessions on this. So I'll be happy to add anyone to those sessions, and because this is a continuous process, not like getting some strategies and simply using it, but implementing these strategies are a very difficult thing in itself, and that's the reason possibly very few people are into this field.
Any questions? So I conclude now,
Right.
Mr. Sunil. On behalf
Right.
of Women and Young Member Excellence Committee, I would like to say thank you very much to CA Suril Mehta for sharing in-depth knowledge and insight of transaction restructuring strategies, and has covered many more areas. And query also solved. I think participants and viewers will really benefited by your guidance lecture, and thank you very much for devoting your valuable time. Thank you, Sri Suril Mehta.
Thank you.
Now, I give my warm regards to CA Deep. Deep is an associate member of ICAI with more than 6 years of experience in consultancy and litigation of indirect taxes. He has worked with various clients across sectors, including solar, power, pharmaceuticals, manufacturing, sports bodies, trading firms, exporters, construction, and works contractors. CADIP is actively delivers seminars on GST at various forums and CPA study circles. He is also managing committee member of CVOCA Association and special invitee of Women and Young Member Excellence Committee. Outside work, he is passionate about reading, Formula One, music, food, and cars.
Thank you, Preeti ji, for such a warm welcome. And I
Thank
would
you.
like to congratulate Suril for such an encapsulating and what do you say, a deep coverage of the topic in the given limited amount of time. He's given a very good understanding of the opportunities available in transaction tax advisory and also shared some of his views with respect to opportunities for our young members. And congratulations to you, Suril. With that,
Thanks a lot.
we'll go to our we'll go to our next topic for the day: refunds under GST. Basically, we all know that GST is a vast topic, and I will in within that as well. Refund itself is a vast topic. I will try to cover as far as possible in the next 1 hour, and we'll discuss any queries. If you have, you all can continue posting in the chat box any queries that you all have. At the end, we'll have a discussion on those queries as well. Okay, so our agenda for this session would be that first we will have an overview of what are the types of refunds that are there and understanding, and a background of those refunds, in which case which sort of a refund is applicable, what are the various formulas through which the refund amount is to be calculated. After that, we'll have a brief understanding of the procedure that is required for filing of the refund application, right? It is basically refund has to be filed online, but is it only an online application, or what are the documents that are required while filing a refund application? And we'll also discuss some of the recent circulars where department has given some clarification on gray areas or on burning issues where department has tried to give their point of view and give a clarification that this is the legal aspect that department is going to accept. So without wasting much time, we'll quickly dive into the various types of refunds. Okay. So there can be majorly two types of refund. One will be refund of the cash amount or the tax that has been paid, or there will be refund of the credit amount which is unutilized tax. Okay. Now refund of cash will be first tax paid on zero rated supplies, excess cash balance, tax paid on advance for which no supply has been done, CGST or SGST paid instead of IGST, that is tax paid under the wrong head, or any other amount. And refund of credit would be unutilized input tax credit due to zero rated supplies and unutilized input tax credit due to inverted duty structure. अब लिस्ट डाउन तो कर दिया, पर ये होते क्या है? ओके, ये होते क्या है इसका हम लोग अंडरस्टैंडिंग अभी लेंगे. Zero rated supplies. Now, this is one of the biggest reason why anyone would go into refund under GST. So what are zero rated supplies? Zero rated supplies are neither exempted supplies nor nil rated supplies. जीरो रेटेड है मतलब इसका मतलब ये नहीं कि इसके ऊपर टैक्स रेट जीरो है, नहीं. दैट इज नॉट अ जीरो रेटेड सप्लाई, दैट्स अ nil rated supply. And zero rated supply also does not mean exempted supply. It does not mean that tax on this supply has been exempted. No, that is an exempted supply. So what exactly is zero rated supply? Section 16 of IGST Act says that zero rated supplies are supplies of export of goods or services. What is an export? Sending a good or service outside of India, or supply of goods or service to any SEZ unit or SEZ developer. So basically, law assumes that SEZ is supply to an SEZ is akin to export. Though the SEZ may be in India, any supplies made to SEZ will be deemed to be supplies made outside of India, and therefore it is treated at par with exports. Right? Now, zero rated supplies can be of two types. One is with payment of tax and another is without payment of tax. अभी आप बोलेंगे जब मेरे पास विदाउट पेमेंट ऑफ टैक्स का ऑप्शन है, मतलब मैं कोई चीज बिना टैक्स भरे सप्लाई कर सकता हूं, तो मैं वो सप्लाई के ऊपर टैक्स क्यों भरूंगा? करेक्ट, बिकॉज दैट इज व्हाट एनी सेन पर्सन वुड थिंक अबाउट, राइट? सो लेट अस गो टू द नेक्स्ट पार्ट. If supply is made with payment of tax, then the entire tax amount will be refunded under Rule 96A. Okay, so say if you are making a supply of 10 lakh rupees and you paid GST of 1,80,000 on that supply, then the entire 1,80,000 will be returned back to you. Okay, so that is the benefit when you go for with payment of tax, that the entire tax amount is refunded back to you. And if you go for tax payment without, export without payment of tax, then the refund will be of the unutilized input tax credit. Now we all know the biggest benefit under GST is the input tax credit, right? Why? Because whenever you are making further supplies, you can utilize this input tax credit towards your tax liability. Now, when you are making supply without payment of tax, your tax liability is going to be zero. So then what happens to the input tax credit that you have availed? It becomes unutilized. So when you are going for export of goods or zero rated supplies without payment of tax, whatever input tax credit remains unutilized. Okay, the key word is unutilized. Whatever input tax credit remains unutilized with you, okay, and there will be a calculation under Rule 89.4 in the given formula. Whatever amount comes in the formula, that will be refunded back to you. So that is the principal difference between zero rated supplies with payment of tax and without payment of tax. In with payment of tax, whatever tax amount you pay on export of goods, the entire amount will be refunded back to you. In without payment of tax, obviously you need not pay any tax, but whatever input tax credit remains unutilized with you, that will be refunded back to you. Okay. Now, there could be a scenario where you make some domestic supplies and some exports. ओके, जहां पे आप प्योर एक्सपोर्ट करते हो वहां पे तो आपका 100% आईटीसी अनयूटिलाइज्ड रहेगा, करेक्ट? बट व्हेन यू आर मेकिंग डोमेस्टिक सप्लाईज एंड आल्सो some exports, then how do you determine unutilized ITC? That is where this formula comes in place, that maximum refund amount will be turnover of zero rated supply divided by adjusted total turnover into the net ITC. So basically आपका ITC जो आपने क्लेम किया है उसका proportionate amount आपको मिल जाएगा in the ratio of your exports to the total turnover. Okay. Then in 2020, just before COVID, there was a notification which said that in case of export of goods in the above, the value of goods exported in the above formula will be restricted to 1.5 times the value of domestically supplied goods by same or similarly placed supplier. Okay, the effect of this was that, say if I am exporting goods at 200 rupees, okay, but the same product I am selling in the local market at 100 rupees. Okay, so ideally my formula here should have been 200 will be my export value, 100 will be my local value. So 200 plus 100 total turnover is 300. So formula will be 200 divided by 300 into the net ITC. So what they did was, they said ki nahi, the value of your exports will be restricted to 1.5 times the value of your domestically supplied goods by the same or similarly placed supplier. So basically, my export value goes down from 200 to 150 because it is restricted to 1.5 times of my domestic supplies. Okay, now what was the effect of this? Basically, instead of 200 divided by 300, so I was eligible for 2/3 of the refund. Now I will only get half the refund. Now this is only an example, actual figures can vary. But then what happened? There was a problem that in the numerator, if you are restricting, in the denominator also you should restrict. Subsequently, in March 21, they came up with circular number 147, which said that restriction in value of zero rated supply of goods to be applied to numerator as well as denominator. Okay, so now instead of 200, my value of exports will be 150. My value of domestic supplies will be 100. Okay, so now how will the formula look? It will look like 150 divided by 250. 250 comes from 150 my export and 100 will be my local into the net ITC. So instead of 150 by 300, after the clarification, it became 150 by 250. So a little bit of relief has been given by way of this circular. Okay, here we can see before this change, domestic supply was 100. Okay, and export supply was 250 and my net ITC was 75. So before this restriction, I would have been eligible for a refund of rupees 54. But after this restriction, what has happened is my export supply of 250 has been restricted to 150. Why is it 150? Because 1.5 times of my domestic supplies. So 150 divided by 250 into 75, my refund amount becomes 45. Okay, now I have a loss of rupees 9. Otherwise, this would have been 150 divided by 350 into 75 and my loss would have been higher. After that, in July 2022, another circular came which said that value of supply of export of goods shall be lower of the FOB value declared in the shipping bill or value declared in the tax invoice, whichever is less. Again, this is a very technical amendment and circular was given that restriction, the above restriction will apply to numerator and denominator both. Okay. Now, what is the distinguishing factor between with payment and without payment? In zero rated supplies with payment, the tax is paid by utilizing ITC and some cash balance if the ITC is completely exhausted. In without payment of tax, the tax will be not paid because there will be no payment of tax. Okay. The refund will be of the tax paid on supply, like we discussed earlier, and here the refund will be of unutilized ITC. Entire amount of tax will be refunded, and here the refund will be as per the prescribed formula. ITC on capital goods can be utilized. So once I claim ITC on any capital goods, I can utilize it towards making the payment of tax, and that tax will be refunded back to me. But where the formula is concerned in without payment, the definition of refund specifically excludes ITC on capital goods. So here there is a loss to me in terms of ITC availed on capital goods. With payment of tax is to be done only on notified supplies, and without payment can be done on all the supplies. Okay. In 2021, Finance Act 2000 budget amended the IGST Act and said that zero rated supplies with payment of tax has been restricted to only the notified supplies. All other zero rated supplies to be mandatorily done without payment of tax. So basically इन्होंने क्या बोला कि हम जो सप्लाईज नोटिफाई करेंगे आप उसको ही विथ पेमेंट ऑफ टैक्स कर सकते हो, बाकी सब आपको कंपल्सरीली विदाउट पेमेंट ऑफ टैक्स करना है. Why? Because we'll see this earlier, but I'll just give you an idea. In with payment of tax, whatever tax you pay, it will be cross-checked with the customs department and immediately you will get the refund. But in without payment of tax, you have to file an application. It will be scrutinized by the officer and only then you will get the refund. So basically they will say कि only in these sectors we have confident that there are no irregular activities going on and here you can directly take the refund. In all other sectors, you have to go to the officer, get it scrutinized and then you will get the refund back. Okay. And the another amendment was that supplies to SEZ will also be restricted only to authorized operation. So if you are making any supplies to SEZ which are not for their authorized operations, it will not be treated as a zero rated supply. Now, with respect to the above notified supplies for with payment of tax, only last month the notification has come, right? The Finance Act 2021 was introduced in Feb 21, but the effective date has been notified as 1st October 2023 after almost 2.5 years. Okay, and basically they say that anybody supplying tobacco, hookah products, khaini, zarda, all of those will have to go through the officer, and everybody else can go for with payment of tax. Once notified. So we'll go to inverted duty structure. Okay, that was zero rated supplies. Now we come to the second type of refund, which is refund under inverted duty structure. Refund of unutilized input tax credit. Again, here the keyword is unutilized input tax credit. When is can be claimed in case of inverted duty structure. Now, what is an inverted duty structure? Inverted duty structure is when your rate of tax on the outward supply is less than the rate of tax on your inward supply. Normally, what happens? You purchase a product at a particular rate of tax and you sell it at the same rate of tax. Correct? But in some cases, like say manufacturing sector, you purchase various products at different rates. You manufacture something out of it and you sell it at a single rate. Right? Now, when you're purchasing multiple products, some could be taxed at 18, some could be taxed at 5, some could be taxed at 28, and say your final product is taxed at 12%. Okay? Because of this, there could be a scenario that you claim the credit entirely, but you are unable to utilize it because your liability is only to the extent of 12%. Right? Now, I'll give you an example. Imitation jewelry is taxable at 3%. Right? But if I am selling it through e-commerce operators, the e-commerce operators charge me 18% GST. Now, what happens? I claim the credit at 18%. Correct? Now, when I sell the jewelry, I only charge 3%. So the balance 15% remains unutilized with me. Okay. Now this will slowly start ballooning and my credit ledger balance will become very heavy. So because of this, the government has allowed us to claim refund wherever we are facing a situation where the rate of tax on inward supply is more than the rate of tax on outward supply. But it is eligible again only when there is accumulation and unutilized ITC due to inverted duty structure. If the accumulation of ITC is only due to change in the rate of tax on the same goods. Say today the mobile phones are taxed at 18%, I purchased and I claim credit at 18%. Now tonight a notification comes that all mobile phones will be taxed at 12%. So tomorrow onwards I have to charge 12%. Now I will be left with 6% extra credit. Government believes that this is only a temporary phenomena and this will not lead to an accumulation in the long term. Once slowly and steadily I start selling at 12%, my profit margin will take care of the unutilized credit, and within a short period of time, the accumulation will be no longer there in place. Hence, there is a circular which says that if there is a change in rate of goods, of the same goods, then refund under inverted duty structure is not eligible. Formula for determination of the refund has been prescribed under Rule 89.5 of CGST rules. The formula says that the refund amount will be equal to turnover of inverted rated supply divided by adjusted total turnover into net ITC. Now, till here, the formula is very similar to the formula we saw in 89.4, that is zero rated supply. Basically, आपको proportionate ITC का refund ही मिलेगा, उससे ज़्यादा कुछ नहीं मिलेगा. But here the addition is, it subtracts the tax payable on such inverted rated supply of goods and services. Okay, so now what happens is, say if I am 100% inverted supplier. Okay, now when I am supplying anything, my numerator will be 100, my denominator will be 100, and whatever ITC I put here, I will get that as a refund. Okay, but we do remember that refund is only for unutilized input tax credit, right? That is why it subtracts the tax payable on such inverted rated. Why? But naturally, any tax that I have to pay, I will pay out of my credit because I have so much credit lying. I will be paying it out of my own credit balance, and hence I have already utilized that credit. And refund is only of unutilized credit. Hence, this subtraction figure is there, which was not there in export of goods. Okay, let us see this example. My inverted duty structure supply is 1 lakh rupees. My normal supply is 1,50,000, and my net ITC is 80,000. Now, my pro rata figure would be 1 lakh divided by 2.5 into 80,000 and amounts to 32,000. But because of this subtraction point, my net refund becomes 32,000 minus 5,000. Why 5,000? Tax paid at 5% on this 1 lakh rupees. Correct? So 32,000 minus 5,000, my refund amount will be restricted only to 27,000. Now, there was a major question on whether this net. Okay, sorry, let me first come to this. Now, explanation to Rule 89.5 says that net ITC, the word net ITC here shall mean only input tax credit availed on inputs. Inputs मतलब goods. अब जरूरी थोड़ी है कि मैं सिर्फ गुड्स ही बेचता हूं, मैं तो सर्विसेज भी यूटिलाइज करता हूं. Correct? I use transportation, I use marketing, I use lawyer, I pay rent. I use so many services in ensuring that my products are sold. Hence, I should be eligible for refund even on these services. My earlier example of imitation jewelry sold through e-commerce operator is again another very typical example of this. Because if I am selling jewelry through e-commerce operators, the e-commerce operators charge me logistics cost, warehousing cost, commission, marketing, advertising, so many charges on which they charge GST at 18%. Correct? And without availing these services, I cannot sell my product through e-commerce operators or anywhere online. Right? So, a petition was filed with Gujarat High Court to say that refund should be allowed even on input services. Correct? Gujarat High Court agreed with this proposition and said that ITC will include all ITC. It will not be restricted only to inputs. Department filed a petition with Supreme Court, and finally in 2021 Supreme Court said that no, granting refund is a prerogative of the legislature. If legislature prescribes certain restrictions in this granting of refund, then these restrictions have to be strictly followed. Hence, when legislature is saying that net ITC will only be restricted to inputs, and by that effect, refund will only be given on the ITC availed on inputs and not on input services, we cannot artificially insert the word services here just to grant a higher refund amount to any sector. And that is how Supreme Court said that the formula as it is correct in law. Okay. But Supreme Court also advised the government to ensure that some benefit and some relief is provided to those sectors who are reeling under pressure because of this phenomenon. Subsequently, in July 2022, government amended this formula and the tax payable was again made proportionate to the inputs and input services. Again, this is a very technical aspect. I will not go into this because this will take another half an hour. But after this formula was amended, government also issued a circular which said that this formula will be applicable to all refund applications made after the 5th July 2022, even if that period for which refund is being applied for is prior to that. So even if I'm applying for refund for April 21 in August 22, then the new formula will apply to me. Now, there is again another notification which says that refund under inverted duty structure will not be eligible for these products: woven fabrics, corduroy fabrics, knitted or crocheted fabrics, railway locomotives, construction services, tobacco and manufactured tobacco substitutes. Excess cash balance. We all are aware that we make payment of tax by two methods. One is by utilizing ITC and one is by payment by cash. For making payment by cash, we need to deposit a certain amount in the electronic cash ledger. When we deposit that amount in the electronic cash ledger, the amount of tax gets debited from there when we are filing GSTR 3B or when we file DRC 03. Now, what happens that if I have to pay tax by cash of only rupees 70,000, but because of a clerical mistake, I deposit 7 lakh rupees in the cash ledger. ओके देन मैंने तो 6,30,000 रुपए ज्यादा भर दिया कैश लेजर के अंदर. तो सेक्शन 49(6) ऑफ CGST एक्ट says that balance in electronic cash ledger shall be refunded to the assessee as per the provisions of section 54 of CGST Act. And section 54(1) of CGST Act says that refund of excess cash balance is to be availed by filing of GSTR 3. Now, for whatever reason, GSTR 3 never got implemented. So subsequently, circular number 125/44 says that refund of excess cash balance is to be made in RFD 01. So continuing our example, that where I have paid excess amount of 6,30,000 in the cash ledger, which is not going to be of any use to me, I can file a refund application online under the category of excess cash balance. I can show that this cash balance is lying with me, which I have of no use. And please refund it to me. The proper officer will scrutinize your application and sanction the refund amount, and 6,30,000 which was paid by mistake will be given back to you. What are the other types of refunds? One is wrong tax paid under wrong head. Say I had to pay under CGST, SGST, but due to some mistake I paid under IGST. Or I had to pay IGST, but due to some mistake I paid under CGST and SGST. Section 77 says that I need to pay tax under the correct head. Okay? जो मुझे भरना चाहिए था वो मुझे भर देना चाहिए, और जिसको मैंने गलत भरा उसका मुझे रिफंड मिल जाएगा. So if I have to pay CGST, SGST and I have paid IGST by mistake, then I need to do two things. One is pay CGST, SGST, which I have not paid, and claim refund of IGST, which I have wrongly paid. This is under section 77 read with section 54. Tax paid on invoices, tax paid on advance, where such advance has been returned back without any supply being made. We all are aware when I receive advance, I need to pay GST on that. Only advance on services, I need to pay GST on that. But what happens if the contract got cancelled and I returned back the advance? In that case also, I need to go and apply for refund. Tax paid on account of provisional assessment. If I have paid extra tax on account of provisional assessment and at the time of final assessment, it turns out that I was not liable to pay so much tax, then the excess amount will be refunded back to me. Or any other amount where the incidence of tax has not been passed on to any other person. So I have borne the burden of a tax which was not liable to be paid in the first place. Then I can apply for a refund of that tax. Why? Because Article 226 of the Constitution of India, Article 265, sorry, not 226, Article 265 of the Constitution of India says that government cannot collect any tax for which it does not have any legislative backing. So, if Parliament has said that tax on this, only this item will be covered, and I pay some extra tax, ओके से मैंने 18 गवर्नमेंट पार्लियामेंट ने गवर्नमेंट को पावर दिया है टू कलेक्ट टैक्स एट द रेट ऑफ 18%, बट ड्यू टू सम क्लेरिकल एरर आई पे टैक्स एट 28%. मैंने 10% एक्स्ट्रा भर दिया. नाउ government does not have the power to collect and retain this tax which is in excess of 10%. Hence the constitution allows me to apply for refund, and because of this constitutional power, Section 54 of CGST Act also allows me to apply for a refund of this extra 10% which I can claim from the government. Now, what are some examples where this any other amount can be useful to us? Recently, a lot of people have come up with an issue which says that मैंने एक amount tax भरा. Say I have booked a flat with a particular builder, and on that amount I have paid the GST. But say 2 years, 3 years down the line, he has failed to deliver, and I have cancelled the contract with him, and he has refunded the amount back to me. Can he refund the GST amount back to me? No. Why? Because the time limit to issue credit note has lapsed. Okay. But did the supply actually take place? No. Is the government eligible to keep this amount with itself? No. Because GST can be paid only on supplies. Where there is no supply, there cannot be any tax. Right? So in such a scenario, even if I am an unregistered person, I can go and apply for refund, and this procedure was prescribed through circular number 188 dated 27 December 2022. So these were the different types of refunds. Now, what is the procedure for applying for refund? The brief overview is, first you make an application. The application will be processed. If you are eligible for provisional refund, you will be given provisional refund. Otherwise, directly an order will be passed. Order can sanction the refund or can even reject the refund. If the refund is rejected, then you need to file an appeal. Right? Now, application is to be made within 2 years from the relevant date. Where multiple earlier the portal did not allow us to club multiple periods. आपको एक महीने का ही refund application डालना था. Then Delhi High Court in the judgment of Pitambara books said that no, the portal has to allow multiple tax periods or even multiple financial years to be clubbed together in a single refund application for various reasons. All returns have to be filed up to the date of filing of refund application. So today, if I am filing a refund application, all returns for which the due date was 31st August 2023 have to be filed. If I have not filed, then I cannot apply for refund. Wherever required, a debit will be made in your electronic credit or cash ledger. Now, wherever required, as in what? Where I am applying for refund of unutilized input tax credit and I file a refund application. Okay, now when I am filing a refund application for this unutilized input tax credit, the amount of refund for which I have applied will be debited from my electronic credit ledger. Or where I say I have this much excess cash balance in my electronic cash ledger and I am filing a refund for that particular amount, that amount will be debited from my electronic cash ledger. Certain documents have to be attached along with the RFD1 list of outward invoices. It is given in the format is given in annexure to RFD1. Some documents prescribed in Rule 89.2 to be attached. If refund pertains to unutilized ITC, then statement of invoices on which ITC has been availed, that has to be attached. If your refund amount is less than 2 lakhs, then a self-declaration stating that the burden of tax has not been passed on to anyone else. If your refund amount is more than 2 lakhs, then a CA certificate has to be attached which says that burden of tax or the incidence of tax has not been passed on to anybody else. Once your refund application is filed, it will be processed. An ARN will be generated. ARN is called as application reference number. If all the documents are correct, all the documents that you have submitted along with the refund applications are in order, then a RFD02 will be issued, which means that there are no deficiencies in your refund application. If there are any deficiencies, say you have failed to attach the certificate or you have failed to attach the list of invoices on which you have claimed credit, then RFD03 will be issued. It is called as a deficiency memo, and you need to file a fresh refund application after rectifying these deficiencies. So if say you have filed an application but you have failed to attach a CA certificate where the refund amount is more than 2 lakhs, say it is 5 lakhs, but you failed to attach a CA certificate, the officer scrutinizing the application will issue a deficiency memo. In that deficiency memo, he will write it down that CA certificate is not attached. That refund application will be closed. You need to rectify that deficiency and again file a fresh refund application. The period between the RFD1 and RFD3, that is the deficiency memo, will be excluded from the time limit of 2 years. Once a new fresh refund application is filed, no new deficiencies can be pointed. Right? In our example, CA certificate was missing. You got a CA certificate, you filed a fresh refund application. In that, you attach the CA certificate. Now the proper officer cannot say कि अरे आपने तो वो document को annexure B भी नहीं दिया मेरे को. Circular says that all the deficiencies have to be pointed out at once. Every time you cannot keep pointing out new deficiencies every time a fresh refund application is filed. If refund is of excess cash balance, then RFD2 is issued first and then the documents are scrutinized later. Now, this was in a general procedure. Wherever zero rated supplies with payment of tax are made, and especially export of goods, the special procedure is prescribed under Rule 96A. Whenever you are exporting goods outside of India, you are supposed to file a shipping bill with the customs department. This shipping bill filed with the customs department is deemed to be your refund application. So you need not make a separate refund application to the government for this. And this refund application is completed the moment you file the relevant GSTR 3B and pay the tax to the government. Any invoices that you have disclosed which pertain to these exports, all the invoices that you have disclosed in GSTR1 are then validated with your customs database. And once these are validated with the customs database, refund application shall be automatically paid to the supplier. Now, this is a special procedure, and as we can say, it is completely automated. Neither do you have to file a separate refund application, nor do you have to submit any documents, nor do you have to go to the proper your jurisdictional officer and ask them ki this is my situation. Direct application, automatic application, and automatic sanction of the refund. Only issue comes where customs database and your GSTR1 does not match, then you need to rectify it to that extent. Otherwise, the refund application is entirely automatic. Now we'll come to provisional refund. Section 54(6) says that if the refund application is on account of zero rated supplies, then 90% of the amount will be paid provisionally before passing on. So the moment you filed an application and an acknowledgement in RFD02 is issued to you, you are eligible for claiming 90% of the amount as a provisional refund, provided you are making zero rated supply of goods or services. But this comes with certain conditions, limitations, and safeguards. The only condition is that applicant should not be prosecuted in the previous 5 years under GST or any other erstwhile law where the tax amount exceeds 2.5%. So basically मैंने 2.5 करोड़ से ज्यादा का घोटाला किया GST में और मेरे को जेल हो गई, then I am not eligible for this 90% provisional refund. Otherwise, I am eligible for the 90% provisional refund. And another criteria is that proper officer has to be prima facie satisfied that the refund application is final. Okay. After the final refund is granted, say मेरा जितना मैंने refund application डाला था पूरा का पूरा accept हो गया, उसमें से 90% तो मेरे को मिल गया था, बैलेंस 10% बाद में मिल जाएगा. बट इफ से मैंने 10 लाख का रिफंड एप्लीकेशन डाला था, मुझे 9 लाख प्रोविजनल रिफंड आ गया, बट आफ्टर स्क्रूटिनाइजिंग द एप्लीकेशन ऑफिसर हेल्ड दैट ओनली 8 lakhs इज पेएबल, तो मुझे 1 लाख रुपया जो ज्यादा आ गया वो 1 लाख रुपया मुझे गवर्नमेंट को वापस करना पड़ेगा विथ इंटरेस्ट. नाउ coming to the order. Once I have filed a refund application, the proper officer is required to pass an order within 60 days from that refund application. If the proper officer is satisfied that the refund is eligible, refund will be sanctioned. If he believes that he is not satisfied and he should reject the refund, then he cannot outright reject it. He has to issue me a show cause notice. I have to file a reply to that show cause notice and appear for a personal hearing. And after listening to my submissions and considering the reply that I have filed, he may either sanction the refund or he may reject the refund. Correct? If he has rejected the entire refund or the refund is rejected partially, I filed a refund application for 10 lakhs. Out of that, 7 lakhs is sanctioned and 3 lakhs is rejected. Okay, so for that rejected 3 lakhs, I can file a appeal with the first with the appellate authority, then with the appellate tribunal, then with the High Court, and then with the Supreme Court in that particular order only. In case of refund, if I am filing an appeal for rejected refund, then no pre-deposit is required to be paid. If my appeal is accepted and this and the appellate authority says that 3 lakhs has been wrongly rejected, he should be sanctioned the entire amount, then I have to file a fresh refund application under the category on account of assessment, provisional assessment, appeal, or any other order, because it is on account of an appellate order, right? So now I need to attach this order with my refund application, and the refund application will only be for 3 lakhs because 7 lakhs is already granted to me. Okay. And the time limit for issuing this fresh refund application will be from 2 years from the date of order sanctioning the refund, not from the original relevant date, but from the date when I was sanctioned this order by the appellate authority. वहां से मैं 2 साल कंसिडर करूंगा, बिकॉज वी ऑल नो इंडिया तारीख पे तारीख तारीख पे तारीख आज का रिफंड एप्लीकेशन हो सकता है, मेरे को कोर्ट से ऑर्डर मिलेगा 10 साल बाद. Correct? Then it becomes redundant if you say that no, 2 years is to be calculated from today, then an order in my favor after 10 years becomes redundant. Hence this benefit is there that 10वें साल से आपका 2 years calculate होगा. So आज से 12वें साल तक मेरे पास time है to file the fresh refund application. Now comes rule 96B. In case of export of goods, foreign currency which is not received within time, then refund given to exporter to be deposited back with the government. Now, first question here is ये क्या है और क्यों? उसके लिए एक फंडामेंटल क्वेश्चन ये है कि एक्सपोर्टर को इतना बेनिफिट मिल क्यों रहा है रिफंड का, राइट? Because the government wants to promote more exports. Now, why does it want to promote more exports? Because it wants more inflow of foreign currency. Why does it want more inflow of foreign currency? To be able to make payment in foreign currency for purchasing oil or any other essential and important products. Now, what happens when it can't do that? We just saw what happened with Sri Lanka. Right? Sri Lanka had zero foreign currency left with themselves. They could not purchase petrol. Hence, they could not give people electricity. They could not transport essential commodities, and entire country came to a standstill. Right? In order to avoid that, you need foreign currency. To get foreign currency, you need to ensure that your products are sold in the other country more than what you are importing. Your exports have to be more than your imports. And to do that, you need to give some sort of benefit to the exporters. Otherwise, why would anybody go into exports? आज मेरा इधर खड़े खड़े माल बेच रहा है, मैं क्यों माल शिपिंग में डालूं, उसको बेचूं, उसका ध्यान रखूं, ये करूं मैं? Why should I go through that hassle? Only when I have some incentive to export my products. But if I export the products and the foreign currency does not come into India, the entire mechanism fails, the entire intention is defeated. Hence, Rule 96B says that if you are paid the refund, but you are unable to bring the foreign currency in the country within the timeline given, then you will not be eligible for this refund, and the sanctioned refund has to be deposited back with the government. Now, say आज तो मैंने refund वापस कर दिया because मैं foreign currency ला नहीं पा. But say 6 months down the line, I was able to get some recovery and I brought the foreign currency into India. Now the purpose of exports is fulfilled. Then I can again apply for a refund when I have brought the foreign currency back into the country. Now, and procedure earlier was not prescribed कि मेरे को refund application वापस कैसे करना है, but now circular number 197 just it has been issued 3 weeks back, which says that fresh refund application has to be made under any other category. Right now, what will be the time limit applicable for this is not yet clarified. Some other important points: if refund is sanctioned after 60 days, then interest is eligible at the rate of 6%. You can claim for interest on such delayed refund. If court has sanctioned the refund and it is paid late, then interest goes to 9%. If you have filed a refund application but you believe that it is incorrectly filed or something is wrong, then you can file an RFD01W at any time before passing of the order, and you can withdraw the refund application and say where your amount has been debited from the cash ledger or credit ledger. Like we discussed earlier, if the amount is debited from your cash ledger or credit ledger, but the refund is ultimately rejected, then that amount will be reinstated back into the respective ledger. And Aadhaar authentication of proprietor, partner, director, trustee is mandatory. Without Aadhaar authentication, it will not allow you to file a refund application anymore. Okay, these are not relevant. In the interest of time limit, I will quickly just skip this. Now, like we discussed earlier, that a deficiency memo can be issued to you, right? And obviously, you would not like that when you file a refund application and you are issued a deficiency memo, and again you need to start the process from the beginning. So how can you avoid that? The simplest reason is by identifying why an RFD03 is issued and avoiding that mistake in the first place altogether. Right now, what are the most common reasons why RFD03 can be issued? Documents that are required to be submitted are not submitted properly. This is one of the most important factors. We need to go through all the circulars properly, make a list of documents that are required to be submitted, and submit those documents with the refund application. If we do not submit any of those documents, then an RFD03 or a deficiency memo will be issued to us. There is a mismatch in your 1 and 3B. राइट आपने जो 1 फाइल किया और जो टैक्स पे किया इन 3B, अगर उसमें ही मिसमैच है, आपकी डिक्लेयर्ड लायबिलिटी एंड पेड लायबिलिटी में ही मिसमैच है, तो ऑफिसर बोलेगा आपको रिफंड चाहिए किस बेसिस पे. द आईटीसी दैट यू हैव अवेल्ड इन 3B is more than the ITC in 2A, meaning you are not eligible for that ITC, then a deficiency memo can be issued. It must be noted that Circular 197 also says that from 1st Jan 22 onwards, the ITC will be verified from GSTR 2B instead of GSTR 2. So this thing now, for any refund applications for Jan 22 onwards, we need to ensure that ITC is appearing in 2B and not in 2A. Okay, and declarations and certificates are not submitted. Now, this is an illustrative list of the forms. Refund application in RFD01. If all the documents are correct, then RFD02 will be issued. If there is any deficiency in the documents, RFD03. If you are eligible for provisional refund, then RFD04. If the order is sanctioned or rejected, RFD06. If it is sanctioned, then payment order will be in RFD05. If your refund is being withheld, then RFD7A. If withheld refund is being released, then 7B. Show cause notice in RFD8. Reply to show cause notice in RFD9. Withdrawal of refund application RFD1W. Appeal to appellate authority APL1. And reinstatement of amount debited from credit ledger or cash ledger PMT03. So this is mainly an illustrative list of some 12-13 forms which are relevant to the entire refund provisions of the GST law. Now we'll discuss some of the recent circulars where government has given us some clarity. Export duty, this is not relevant. Now, okay. Export of service is defined under Section 26 of IGST Act. Some conditions are given. And at the end, it says that if I am supplying some services to my overseas branch, my own branch, then it will not be it will not be covered under the category of export of service. Now, what happened was department said that if I have a subsidiary, department officers started rejecting export benefit on services given to subsidiaries as well, foreign subsidiaries. Correct? Now we all know subsidiaries and branches are not the same. Branch is my own entity. Subsidiary is a separate entity altogether. Hence, circular number 161 was issued, which says that company incorporated in India and another company incorporated under foreign law are separate legal entities and not establishments of the same person. Hence, supply of services by Indian company to foreign subsidiary company incorporated under foreign laws will be considered to be export of service and not barred by the above restriction. Okay, so this was one very useful clarification for various MNCs who were operating in multiple countries and providing services to companies located outside India, but they were unable to claim the refund of those services. Now we discussed that section 77 says that if I have paid tax under the wrong head and I subsequently find out that tax was to be paid under a different head, then what I need to do. Now, department said that subsequently held includes where either I myself identify the mistake or the mistake is identified by the tax officer also, then it is okay. नहीं तो डिपार्टमेंट क्या कर रहा था, वो बोल रहा था अरे ये गलती आपने थोड़ी ढूंढा, ये गलती तो हमने ढूंढा है, तो आप करेक्ट हेड में तो टैक्स पे कर दो, पर जो रॉन्ग हेड में आपने टैक्स पे किया वो हम आपको रिफंड नहीं देंगे. Then circular number 162 said that no, this is not the correct approach to the law. Even if department officer is finding out the mistake and the assessee is willing to rectify that mistake, then refund under section 77 was eligible. And this stand of the department, this circular of the department was accepted by the Punjab and Haryana High Court in the case of SBI Cards and Payment Services Limited in 2021. Balance lying in electronic cash ledger can be claimed by RFD01. We discussed this. Now, what happens is when I'm making any supplies through e-commerce operators deduct this amount, deduct a 2% amount as TCS. They pay this TCS to the government on my behalf. I need to file a TCS return and this amount of TCS is given back to me in my cash ledger. So instead of this 2% coming into my bank account, it comes into my cash ledger and it remains there in the cash ledger. Now, when say I have some excess balance in my cash ledger on account of this TCS and I file for refund application, department took a stand that this does not satisfy the bar of unjust enrichment. What does unjust enrichment mean? That somebody else has borne the burden of this tax. This burden of tax is not borne by me. Why? क्योंकि ये पैसा तो ई-कॉमर्स ऑपरेटर ने भरा है. अगर ई-कॉमर्स ऑपरेटर ने भरा है तो ये आपका पैसा कैसे हुआ? उसका बर्डन तो ई-कॉमर्स ऑपरेटर ने बेयर किया है. Then how are you eligible for this amount? Andhra Pradesh High Court Telangana High Court in the case of Appareo Retail Private Limited held that this stand is incorrect. The TCS itself is deducted from the amount which is payable to the taxpayer and only then it comes into his cash ledger. The e-commerce operator does not pay the TCS from their own pocket. They deduct that amount from the supplier and only then they deposit it with the government. Hence, the burden of this tax is borne by the taxpayer only, not by the e-commerce operator, and hence the doctrine of unjust enrichment is not applicable in this case. And ultimately, department accepted this view and they issued circular number 166 in November 2021. Concessional rate. We discussed earlier that where I am supplying the same product, but the rate of tax is lower due to some benefit by the government, say that they change the rate to give us the some benefit. In that case, I am not eligible for inverted refund under inverted duty structure. Now there is a scheme called merchant exporter. What does a merchant exporter do? Basically, वो एक जगह से माल खरीदता है और वो सीधा उसको एक्सपोर्ट कर देता। तो इससे क्या हो रहा था, वो 18% पे बाय करता था, फिर वो एक्सपोर्ट करता था, फिर रिफंड डालता था, तो उसको पैसा उसका 18% तब तक ब्लॉक हो जाता। Government came up with a scheme and said that okay, anybody supplying to merchant exporter can supply the goods at concessional rate of 0.1% subject to fulfillment of certain conditions. Now, if I am supplying my goods to a merchant exporter, I will buy at 18% and I will supply it to him at 0.1%. अब प्रोडक्ट तो सेम है, करेक्ट, एंड आई एम नॉट एक्सपोर्टिंग, तो मेरा अनयूटिलाइज्ड क्रेडिट का तो मुझे रिफंड मिलने नहीं वाला। एंड प्रोडक्ट तो सेम है, तो मुझे इन्वर्टेड ड्यूटी स्ट्रक्चर में भी रिफंड नहीं मिलेगा। तो जो मैं 18% पे खरीद रहा हूं और 0.1% पे बेच रहा हूं, अनयूटिलाइज्ड आईटीसी का क्या होगा, करेक्ट। सो in this case again circular number 173 was issued and said that any product which is supplied further at a concessional rate will be eligible for refund under inverted duty structure. So this is the broad overview of the issues and complexities of the refund under GST. I have not gone further detailed. Of course, this explanation and this conversation can go on for another hour, but respecting the time restrictions, we will quickly jump on to question and answers if there are any question and answers, ma'am.
So I guess there are certain questions. My name is Gunjan. Can you hear me?
Gunjan, your network is, I think, a bit patchy. Gunjan, your network.
Can you hear me now?
Yeah, much better.
What happens if there are, somebody has booked wrong invoice? So can we get the?
Gunjan, you're not audible to.
Now is it better?
Yeah, it's better.
Okay, so somebody has asked the question: what happens if somebody has booked a wrong invoice? So can we get the credit for the same from export?
Export invoice is incorrect or normal.
Yeah,
invoice.
export invoice is incorrect from which we need a refund.
Okay, so basically in that case, the first option is that you can simply get the invoice amended and the shipping bill amended once they will match, and then the refund will be sanctioned. Correct. If you are gone for without payment of tax also, you can amend the invoice on the GST portal, get the shipping bill properly amended from the customs department, and submit the copy with the proper officer and say that this is the correct invoice and the refund assessment should be done as per the correct amount. नाउ इनकरेक्ट एज इन आई डोंट नो उन्होंने ज्यादा अमाउंट डाल दिया कि कम अमाउंट डाल दिया। रिफंड एक्सपोर्ट के केसेस में प्रॉब्लम विल बी वेयर योर export value is higher and you put lower amount, your refund amount gets reduced drastically, and that is where the main issue will come, where the officer will contest you or dispute you. If say your invoice amount, original invoice amount is higher and you are now lowering that amount, means your refund amount will also be reduced to that extent, and in which case the officer will not contest. But in either case, best option is to get it amended in the GSTR 1 itself. If that is not possible, then justify and prove it to the officer why a different amount needs to be taken.
Okay, thank you very much. And one more last question.
Yeah, sure.
So what are the documents which are required to be uploaded on the site?
Okay. So actually, there is a very exhaustive list of documents that are required to be uploaded. The list of these documents is given in circular number 125, which was issued on 18th November 2019. Just to give you an idea, wherever I am applying for refund under refund for exports, I need to give details of all the export invoices. I need to give details of all the foreign currency receipts by way of, say, foreign inward remittance certificate or bank remittance certificate. These certificates are issued by the banks. Whatever ITC I have claimed, I need to give a list of those invoices. I need to submit the GSTR 2A as well, and now 2B now onwards, GSTR 2B, so that the officer can verify whether the ITC availed is appearing in the 2A or 2B. I need to give my own self-declaration or the CA certificate and some more declarations or certificates depending on the category of the refund application.
Okay.
Detailed list, like I said, is available in circular number 125.
Thank you. Thank you, Chair, for your wonderful insights in GST refund. I guess everybody would have loved the session.
Thank you. Thank you, Gunjan, and thank you, the Women's and Young Members Excellence Committee. It's my own committee. I'm an invitee on this member, and I would like to thank Chairperson Preeti Savla, Vice Chairperson Shri Abhay Chajet, and all the committee members for giving me this opportunity. Thank you so much.
Thank you very much. Thank you.